Hello, everybody. I thought today we would have a discussion about capital budgeting, such a crucial area, and it's sort of a wrap on our whole series of chapters on the budgeting cycle. So yeah, I'd like to talk about that. I'd like to do some illustrations on Excel that is embedded in the chapter that you're going to read, and utilize that to, hopefully bring together the whole concept of present value. So yeah, so we've been talking about as a whole something called the master budgeting cycle, which are schedules, set of schedules, which is essentially your operating budget, which we worked on, your cash flow budget, which can be different from your operations. And then we're going to wrap today by discussing capital budgeting. So capital budgeting refers to the process whereby we determine how we're going to acquire and pay for the maintenance of our long-term assets. So the term capital assets is interchangeable with long-term assets, is interchangeable with fixed assets. Those are all similar concepts. And you'll recognize the need to acquire capital assets as part of the strategic planning process. And you should, the output, or one of the many outputs from a strategic planning process, is a CIP, a capital investment plan that says, hey, if you shelter feral cats or kids or pre-release folks, here's the kinds of facilities you're going to need over the next 5 to 10 years. Or the example in the book was you ran a soup kitchen, a food bank or soup kitchen, and you needed to acquire new assets in your kitchen. So what are we going to need to get us through the next 3 years, 5 years, 10 years, etc. So your capital investment plan is one of the outcomes of a robust strategic planning process. So to define a capital asset, it's an asset that is going to, that you set thresholds for cost and years of usage. So, clearly if I'm buying, some low grade office furniture, something for my conference room, and I go to Target and I buy some chairs, I mean, those are long-term in the sense of I'm not going to throw them away in the first year of their use, or after 1 year of use. I'm going to have them maybe 2 years or 3 years or 5 years. But, cumulatively, they cost $300 and they're probably going to last about 3 years. So I may or may not decide that that's a capital asset. So, and that is a different threshold for every organization. So, say a mid-sized organization might say, we don't consider anything a capital asset unless it's got a cost of $3,000 and a life of 5 years. So anything below those thresholds would be immediately expensed. In other words, they would go right to, office supplies, or they would go right to, a repairs and maintenance account. So they're not going to be set up as a capital asset and depreciated over time or financed over time. And those things are mutually exclusive. I mean, you may pay cash for a capital asset, you still have to depreciate it. So my point is that for every organization, those thresholds to consider something capital is different. And I encourage you in your organization to ask that question. Hey, what is our threshold for capitalizing a fixed asset? And your CFO or your treasurer should be able to tell you those parameters pretty easily. Okay, how do you acquire capital assets? It can happen in a number of ways. You may acquire them from purchasing them. That would probably be the most common. In the case of facilities, you may build it. You may be building a animal shelter or a battered women's center or a nonprofit daycare center, or, it may be something where you require a facility, so you can buy it, you can build it, and sometimes you get donated fixed assets. And there was a really good example in the book about how a gentleman wanted to gift or donate a very large home to a drug treatment program for youth. And the CFO had to go through a pretty sophisticated analysis to determine if that was really a good fit for them, for their mission, and also from a cost basis to convert this large piece of property into something that's appropriate for drug treatment rehab center for youth. So my husband's the CFO for a local nonprofit, and they've had some interesting things gifted to them that's actually ended up costing them more than the asset was worth. And it's a tough thing to say to a potential donor, like, thank you so much for thinking of us, but this is not in our best interest. So read that case study and kind of think about that. Okay, so there's lots of ways to break down capital assets. The text that we're reading suggests one of the ways is capital assets that generate revenue versus capital assets that don't generate revenue. So a capital asset, an example of a capital asset that might generate revenue is I am building a wing onto our existing modern art museum, and it's going to be an interactive children's museum, and there's going to be admission fees or sponsorships. So I'm actually seeing this capital asset generate revenue. So, and I've got a couple different options on how to construct this and how to, who I might utilize to do this. And what the comparison there is between potential revenues versus the expenses. So that's a pretty traditional assessment if you're considering capital assets that generate revenue. If you're looking at a capital asset acquisition or build that doesn't generate revenue, such as the example of the shelter that's going to provide for feral cats, then you've got, oh, here's my dog. Hi, Rio, speaking of animals. Then you've got a comparison between your purchase price and the long-term operating and maintenance costs. So because there isn't going to be any revenue from my shelter for feral cats, there's just going to be costs. So, and I've got a couple different options. There's a couple different pieces of property I'm looking at, or maybe existing facilities that I think I can convert. So then I've got a more, I guess, sophisticated analysis, which is which is going to cost me less in the long term. So I'd like to just walk through the example in the book and make sure that you understand how to do this. I'm going to share my screen and blow this up. So first, let me just paint the picture as the, there we go. Let me just paint the picture as the book talked about it. I think the example was I had two options to upgrade the cooking stations or something in my kitchen, something in my industrial kitchen for my food bank. And one of the options was to purchase, I think it was a commercial grade stove. I'm just going to go with that for $100,000. And then I've got to look at my operating and maintenance costs. Okay. Operating costs, of course, being, the cost of the energy, probably that would be at the cost of the energy. And then maintenance costs is what is it going to cost to keep it up on an annual basis, to keep it calibrated and cleaned and, just all the annual maintenance costs. So the first option is a little bit more expensive. And these are called O&M expenses in accounting lingo. That's just kind of what we call them, O&M. So my operating and maintenance costs, my O&M costs are obviously $7,000 annually. And then my other option is to purchase this for $90,000, and it has $10,000 a year annual O&M. And we anticipate that either of these stoves, commercial stoves, are going to give me a 10-year life. So if you didn't understand the concept of present value, which I'm going to explain in just a second, you might go to this and do a very simple calculation, which would look like this. And your very simple analysis would be, well, let me make this bigger, sorry, so that you can see it. So I can see it. Okay. You might say, well, let's see, 10-year life. This thing's going to cost me $100,000 up front, right? And then I'm going to pay $7 grand a year for 10 years. So I write a simple formula, and it's like, oh gosh, that's going to be $170,000 over that 10-year period. Or option 2, 90 grand up front, 10,000 bucks a year for O&M, 10 years, 190,000 bucks. I'm going to go with this guy because clearly that's cheaper over 10 years, right? That's a simple analysis. It's also erroneous, and here's why. Well, let me ask you, we're not in here together, but think about this yourself. Why do you think that I can't just do this? Why is that inappropriate, or why is that going to not yield the correct result? And the answer is because it's over a time period, over 10 years, you have to use something called present value analysis. And present value analysis says that dollars in the future, i.e. in 1 year, 2 years, 3 years, 4 years, all those years where you're paying the O&M costs in the future is not the same as a dollar today. So, you know, and the best way to think about that is if somebody said, hey, do you want, you know, $10,000 today, or you want $10,000 in 5 years? Obviously, you're going to say I want $10,000 today because I can put it somewhere and earn interest, and it's going to be worth more in 5 years, right? So that's called compounding. When you bring dollars in the future back to today, it's called discounting. So future value, compounding, and it has to be at a set interest rate. So future value says, hey, if I put 10,000 bucks in the bank today and earn 5% a year, what's that going to be worth in 5 years? That's called future value. And we have to apply some sort of factor to that $10,000, and we'll get the amount out in 5 years. Conversely, if you've got some amount out in the future that you want to know what the equivalent dollar value would be today based on a particular rate, that is called discounting. And here's how you do present value analysis. So we've got, with the present value analysis, we've got the $100,000 today, which is just 100,000 because that's in today's dollar. But we do have this interesting thing here where we've got $7 grand a year for 10 years. And we want to bring that amount back to the equivalency of today's dollars. So we've got two things going on here. We've got the actual $100,000. And you don't have to present value that because that's already in today's dollars. But I do have to bring the O&M costs in the future back to today. So I'm going to go up to something called function, insert function. And if you've never been in here in Excel, there's all sorts of different categories: financial, math and trigs, statistical, lookup. I mean, you can read all these. Some of them are way past my capacity. Most of the ones I use are either lookup or financial. So we're going to go to financial. And in there is going to be a whole list of financial functions. I can just go to most recently used because I use this all the time. And it's right here, PV, present value. And they give me what's called the parameters. I have to put in these parameters, and you can see it's also setting up a formula over here for me, and it will make the calculation. So the first thing it wants to know is the rate. And the rate is called your discount rate. And it is generally, you would utilize what your normal cost of capital is. So if you went to the bank to borrow money, or if you were issuing stock and you paid dividends, I mean, that's not going to happen in the nonprofit world. So what do you borrow money at? So my rate is 4% APR. And I'm going to give you that number. You know, just use a number that makes sense, 4, 5, 6%. Okay, and then it wants to know how many payment periods are we talking about? And we know that this thing has a 10-year life, so my number of periods is 10. And then it wants to know how much is your annual payment? How much is the payment made each period? And it cannot change over the life of the investment. It has to be the same amount every year. And in the first example, the total of my O&M are $7,000. So I look at that, and that $70,000 discounted back to today for 10 years is obviously going to be some number less than 70,000. And it's 156, 766, 27. So in this case, my number is $156,000. So I encourage you to use Excel, bring it up. You can turn off the tape, plug in your formula here, and then we'll decide which one we think is more advantageous. So go ahead, bring up Excel, turn off your tape, and do the present value analysis on the other one. Same rate, same number of years. Okay, so look at what we just came up with. In our simple analysis, we would have gone with option 1 because that looks cheaper over 10 years. But in, oh, well, I guess it's the same answer with both, but it wouldn't necessarily have to be. When we did the present value analysis, it's still better to go with option 1. But the point is, the numbers look really different, don't they? Because that $10,000 a year over 10 years discounted back is a different number. So you always have to use present value analysis when you're doing anything out into the future. Okay, the last thing I'd like to talk about, and this is what your homework's going to look like. I'd really like you to set it up so that it looks nice and you could present it to somebody and they could understand pretty easily. This is called life cycle costing or life cycle analysis. So it's looking at more than just the upfront cost. It's recognizing that it's over the lifetime of the fixed asset. Okay, the next thing I'd like to talk about is how you finance this asset. And there's a couple different ways to do that. Let's see. Okay. I hope we're back here. So there's a couple different ways to do that. One is you may have cash. So the two general modalities are you finance it with debt or you finance it with equity. And if you finance it with equity for a nonprofit, that means that you've built up cash like through an endowment, or you're going to fund the payments out of regular operating cash. So however you, whatever your annual revenue streams are, you're going to utilize those. Or let's see, there's another method. Oh, or you're going to do a capital campaign. So a really, really dedicated fundraising campaign to raise the, whatever this is, $100,000 or, $1 million for the feral cat shelter. You're going to do a capital campaign. So that's called equity financing. Okay, you're not going to borrow the money. Alternatively, you might go borrow the money, and that's called debt financing. And for most of the organizations, I think that we're all dealing with, you would probably, that would require going to your banker. And you would borrow the money and you would finance it over a certain term, right? 10 years, 20 years, 30 years. If it's a building, a piece of real estate, that's called a mortgage, obviously. And if it's for an asset, like in this example, the commercial kitchen, it's not real estate, it would be a note. You would sign a promissory note and you would have principal, interest, which is always quoted as an APR, and principal, interest, and then the term. And then they actually talk about this other modality, which is issuing bonds. Most of our organizations, maybe Greater Yellowstone, or there might be a couple of them that are big enough that they would actually be able to issue bonds. So a nonprofit can't issue a bond on its own. It has to do it in congruence with a municipality, like a local government or a state government. And this is for big stuff. This is like, I'm building a mental health wing for transgender youth onto our existing mental health center. Or I'm putting up a hospital, or I'm putting up low-income housing. I mean, these are big multi-decade projects. And in that case, you may partner with a municipality and issue bonds. And that's super beneficial because municipalities, when they pay interest on the bonds, it's not taxed to the person that's purchased the bonds. So it allows the municipality to issue them at a lower rate. So that saves them money, right? That saves them financing money. So the last thing I just wanted to show you in the last couple minutes, and then I've got another Zoom, is if you are taking, if you are borrowing money, how do you determine what your payment schedule is going to look like? So I want to take us back to Excel, and let's do a loan amortization schedule. So I'm going to go to File, New, but this time, instead of just opening a blank worksheet or blank workbook, I'm going to look, and again, mine's right here because I use it a lot, but you could, this is a template, and there's lots of different kinds of templates. And if you've never looked through these, oh my goodness, they're all set up and you can just plug in, for budgets and planning, tracking projects, etc. So I want to go into a loan amortization schedule and I want to create it. And this is so easy to do. I am good. Let's just say that I was going to finance that kitchen and commercial kitchen, and it was $100,000. And 4%'s already in here. And the bank's gonna charge me 4%. Oh gosh, now I've got a cat on my lap. This is crazy. 4%. And I think I'm gonna pay it off, let's say over 7 years. And I'm going to pay 12 times a year, monthly. And I'm going to start the loan. I've got it on today, but let's say, and that's fine. And I'm not going to make any extra payments. Okay. All I've done here is entered those 3 really simple things, or 4 really simple things. I can find my payment. I can find how much interest I'm paying over the life of it. And then I can follow how my note is being paid down every month. You can use this also, you guys, really easily for your own personal stuff. But we're talking about our nonprofit now. So this is a really great way to compare. So maybe, 14,000, what if I think maybe this 1,300 a month is going to be a little much. So let's put the loan over 8 years. Okay. Gosh, my payments go down, 100 and whatever that was, 15 bucks a month. And obviously I'm going to pay more interest over the life of it. So loan amortization schedule, how you repay your debt. This is called, you repay your debt in a level mode. So that makes it easy to budget for, exactly what your payments are going to look like, and what your cash flow outflow is going to look like. So thank you. I hope that you learned something from this lecture, and I look forward to seeing you guys again. And let me know if you have any questions. Okay, take care. Bye.